if you don't have a bulletproof track record that's like top notch, I think it's okay. It's totally fine. We've underwritten firms with negative track records before. The key is that, have you learned from those mistakes? Have you shown that you have this culture of continuous learning? I think that's more important than somebody who has only been successful, because I think over time you will run into challenges. You are going to make mistakes, but the key is to be able to continue to learn from them. And if you're transparent about what those are up front, it gives us a lot more confidence in the relationship.
At Context Ventures, our podcast, Advancing VC, covers all things startup and venture capital, primarily how startups and venture capital are changing. We chat with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital. Today, I'm delighted to chat with Aakar Vachhani of Fairview Capital. First and foremost, is it a car or a car? Because I've heard multiple
A car is
podcasts.
good, yeah.
A car.
That's good, yeah.
Okay. I've heard multiple podcasts where someone called you a car and someone called you a car.
Yeah, no, you're good.
Okay. Aakar, can you please share about Fairview taking a chance on you back in 2008, your willingness to take calculated risk on championing deals because of your faith in relationships, and how your personal philosophy has developed through your career and how it shapes you as managing partner at Fairview today?
Two of the things, I mean, relationships and risk, those are things that I've been spending more time thinking about of late, especially as we're seeing all these advancements in AI, seeing a lot of changes in the venture ecosystem. The emerging manager world is changing. And I do feel like in the private markets, the human element has always been really important. I think we've been through some time now where maybe it's been overlooked a little bit, but it's coming back into the forefront. And so I do think it is a bigger risk to pass on an opportunity where you have a lot of faith in the relationship, you have a lot of trust, and there's a lot of good intuition on the other side, even if there's not complete data, right? And I think that entire concept ties back both to my career as well as how we invest at Fairview. So from a career perspective, I started at Fairview in 2008. I was 23 years old. I didn't have an Ivy League degree. I had no investment experience. I was first generation in the US, zero connections, and yet Fairview took a chance on me. And so it was a situation where I was like totally didn't fit the mold and definitely had the odds stacked against me. But it turned out that Fairview actually also is a firm that has had the odds stacked against it and doesn't fit the mold. And so there was some level of connection there. And I think I'd done enough good work in my prior firm, which was Cambridge Associates, to get the job eventually. And from there, one of the things about relationships with people that I've learned, and this has been the lived experience from that early experience at Fairview, is that if you have faith in a relationship, especially for somebody, you give somebody a chance that's really looking for one, you're going to be reciprocated back in a positive way more often than not. And in my case, I was so happy to have that opportunity. I mean, it's so hard to break into this industry, as you know. I didn't take it for granted and I worked really hard. And that allowed me to build trust really quickly with the team and also have more responsibility. And part of that, you mentioned the San Francisco office. I think that's an extension of all of that. Fast forward several years, I think I was 30 years old and made the case to open an office in San Francisco. And what multi-billion-dollar firm is going to allow a 30-year-old to move across country and open an office in a new city, like a major new city and market for them? Typically, the playbook is like, okay, we'll send some senior partner or we'll hire somebody who's already embedded in the local ecosystem because that was the goal. I had neither of those things, but what I did have was the trust within the team, and I think I displayed enough good intuition that they were willing to take a chance on me, and so that's been really successful. That's definitely core to how we look at building our team, and then relationships too on the investment side, which I suspect we'll talk about this a little more, but on the investment side, I mean, we are very adept at looking at opportunities that don't fit the mold, that are outside of the box. As long as there's people that we trust and relationships, we think will be reciprocated. People with good intuitions, we always think it's worth taking that shot.
a few things. One is, let's talk about the roots of Fairview. My understanding is the name actually is the mission.
Yes.
And
Yes.
and oftentimes people gloss over
Yeah.
Fairview, but like
Yeah.
it's you all take a fair view on the GPs that pitch to you all. Is that
Yeah.
agreed?
Absolutely. Yeah. We want to take a fair view of the market, so be inclusive as possible in our pipeline. And then also when it comes to managers, like don't judge them, let them be who they are and treat them with respect. And, we've tried to create this. We have a culture and an environment where we think managers are comfortable coming to us because part of it is lived experience. Like we, as a fund of funds, we have to raise capital. We know what it's like being on the road, starting a firm, being rejected all the time. And so we can better relate to these GPs. But we also treat them with respect and hear their story and, don't care what their packaging looks like. We want to hear their ideas and what they're trying to build. And, we also try to give feedback to GPs. So even though we're saying no 99% of the time, we want to create a culture where GPs are comfortable coming to us because even if they know they're not going to get an investment, at least they're going to get some good advice and help. And that's really been key to some of our success.
I want to do some run through the numbers on Fairview.
Sure.
And so this is collected through some podcasts. Some of these podcasts are dated, but I
Sure.
want to give some context to listeners.
Okay.
So 3.5 billion of assets under management, probably a bit higher now.
Yes, a little higher. Yeah, 10 billion in committed capital, but about 3.5 of that or a little more is active today.
And Fairview is 31 years old, 32?
It'll be 31 this year.
31 this year.
Yeah.
How much of a party was a 30-year party?
30 was fun. We had a great celebration last October in New York with, I think it was like 200 plus people, GPs, LPs, a lot of people that made the Fairview story possible. Was our annual meeting that day too. So it was a wonderful, wonderful celebration and reflection.
And you all started co-investing around 11, 12 years ago.
It's about right. Yep.
And your framework for looking at, you generally want to look at funds that are over 40 to 50 million.
Usually, yeah. I think we've gotten to the scale now where it's hard to do the really small funds, and we build equal weighted portfolios. So we want every investment to move the needle in the same way, and so it's hard to do really small checks. But around that size is also the size we think that most firms can support, like an institutional infrastructure and build out a team, et cetera. So that's kind of where we are today. Yeah.
I want to double click on what you just said
Sure.
because as I was listening to other podcasts, and one of them is extremely great, the 10x one. So I want to give a shout out to that. It's Fairview, I think, not only in terms of name, but in terms of your apparent check size into GPs is also roughly the same.
Yes.
And what I found also interesting is the fairness also is between years, you all don't try to overdo it. You just, it's almost like dollar cost averaging.
Yes.
Is that a good read or not?
Yes, consistent deployment of capital is, I think, one of the golden rules of venture and emerging manager investing. You can't time the markets. You don't want to be in and out of the market. So we try to deploy as steadily as we can, despite the markets. I mean, we don't always control that, but as much as we can, try to have vintage year diversification and equal deployment. And then equal weighted portfolios have been really important for us. Yeah.
What I find so fascinating is that on the other podcasts, you're like, yes, we have our favorites, or we don't say we have our favorites, but there are certain funds we like, but you're still fair. It's like, hey, this is what we apportion.
There's the same bar for everybody.
Same
exactly.
bar. Yeah. And what I also liked hearing was the upfront discipline. You really like the aspect of firms being very disciplined upfront and carrying that discipline throughout the life.
Consistency is key to building an enduring firm.
A few more by the numbers.
Sure.
You all allocate roughly 20% for co-investing.
That's right.
And you have at least 9 funds across your portfolio.
So we typically in a fund of funds portfolio will do around 15 is more standard for us. And then we're actively deploying, if you're talking funds of funds, yes, it could be up to like 9 pools of capital at any given time.
When you talked about your move to San Francisco, my understanding from listening to the other podcast was that you're from Connecticut, and that is from Fairview's, like they're based out of Connecticut.
Yes, yeah.
How did that transition go from Cambridge Associates to Fairview? And it sounds like they gave you a Fairview.
Right. Exactly. Yeah. The career trajectory. I mean, I don't think I would have planned it out this way. And especially before I started at Cambridge, I mean, I didn't even really know what I wanted to do, but Cambridge gave me a wonderful window into this world and helped me hone into the parts of the market that I was really passionate about, which are venture, emerging managers, and Fairview was a way to be on the deal side. And then San Francisco, I think, kind of happened organically. It was something that I think the firm was thinking about anyways, because having started in Connecticut, good reasons for that, because a lot of the early roots of the venture fund of funds industry go back to Connecticut for a lot of reasons. But more than half our investments are West Coast, San Francisco, and by the time it was clear we needed to be out here, what was very evident was that the rate of new firm formation was really starting to rise, especially with the advent of cloud computing and cloud services. You just saw a really impressive increase in the number of seed stage opportunities and funds, and a lot of that was happening out here. So it was a bit of an imperative to be here as well.
In terms of indexing and understanding emerging managers, I feel like you all have a good pulse and good read. In 2021, a surge of them, including ourselves, starting.
Yeah.
Has it become easier because there's been less emerging managers started, or is it always like how does the job get easier or harder?
I don't think there's less emerging managers that have been started. We saw a record number of first time funds last year. And I think this year, we'll get the data soon through mid-year, but it seems like there's a really high rate of new firm formation still. It's taken different forms. So height of the market, I think you saw a lot of new entrants to the industry, people that weren't VCs before. This year, I'm sure, as you know, as your audience knows, like there's been a ton of spin out activity, which I think has kind of made up for fewer people entering the industry. But there still are plenty of new people, but there's this new heightened path through which firms are being formed. It's kind of buoyed the statistics. So it has not gotten easier at all. There's so many new firms, and I think that will continue. Actually, I think we'll continue to see more firms. It just creates a higher dispersion of returns. It places a lot more pressure on manager selection. And we talked about like having an inclusive pipeline. We still want to maintain that because you never know where the best opportunities are going to come from. The second you think that you have a good enough network or that where the best firms are going to come from, I think is the second you lose in this category, because people are always coming to this industry with fresh ideas from different places. And so if you're not open to that, you're going to miss it. So our job has gotten harder, but there's more opportunity than ever is the trade-off.
You all, over the 30-year span, have done over 50 first-time funds. What stands out for these first-time funds in terms of what they brought to the table?
First-time funds are hard. Yeah, we've done over 50 now, which sounds like a lot, but we've been around 30 years. So, but we still probably do 2 or 3 a year, and it's probably the most consistently active program in the emerging manager space. So it's a lot, and I think you learn a lot doing Fund One. Some can be very successful, others struggle, but we're generally in it for the long haul, and more often than not, they'll pick it up on Fund Two or Fund Three. We were just looking at a stat. I think 95% of our first-time funds have gone on to raise subsequent funds. So it's a pretty good success rate. If you can pick first-time funds well, I think you'll be really rewarded. And first-time funds are unique because there's something new, right? The founders of those firms are also going on an entrepreneurial journey. So the underwriting is different, the diligence is different, the level of involvement that you have in those opportunities is very different. It's a very different style of investing. You're not just allocating capital, you're an active investor when it comes to deploying in that part of the market. And but it's fun. And it's actually the most rewarding. Like the most rewarding investments are those first-time funds that end up becoming really successful because you help catalyze that firm and that vision from day one.
I've heard that you've guided GPs on what to wear to meetings.
Yes, from time to time, yes.
And I was interviewing Jamie of Screen Door a week or two ago.
Yeah.
And I asked, as part of your investment, do you all take an LPAC role? And she's like, yes, we always do. Is that the same case for Fairview or not?
Same thing. I mean, I don't think you can be successful in what we do, certainly in emerging manager investing, probably even venture as an LP, if all you're doing is being an allocator. If all you're doing is looking at opportunities that come to you and then making a commitment and then monitoring that investment, that's a very passive way of investing. And I think in the long run, you may do okay, you may do good, but you're not going to do you're not gonna have elite performance. The way you get that is by being a force multiplier as an LP, and you have that power because these firms, like I said, are going on an entrepreneurial journey, and every firm is different. They have their strengths, they have their weaknesses, they have their areas in which they need help. So the LPAC is a start, but we often say, we go well beyond the LPAC, and it's really like rolling up your sleeves and helping, trying to make sure these firms are on a path to success. And the good thing is there's a lot of information out there, right? There's a lot of conferences, there's tons of panels, there's tons of blogs out there, podcasts, right? So firms are a lot more sophisticated now than they used to be in the past. But again, they still have their weaknesses. And because every firm is different, we find that we need to really tailor how we work with firms for each firm. And more tactically, I think it takes probably a few forms. I mean, the number one thing we get asked for is help on fundraising, right? Introductions to LPs is probably the top request. And there we only make introductions when we're committing to the fund. And I think the market knows us as a thoughtful, investor and a leader. And so it's a positive signal to the market. And there's a high conversion rate. So to like give an example, there was a first time fund that's just getting started, spinning out of a corporation. Great team. They've done several funds within this company, but they've never raised outside capital. And so that was an area of need for them. And so we were able to make a lot of high quality introductions. Of the first close of outside capital, I think more than half was us and other LPs that we introduced. So it really moved the needle and it got the ball rolling. I think now they're in a position where they could like pick the rest of their LPs, but that can be really impactful to the trajectory of a firm. The other thing we get asked for a lot is help on like materials and marketing, branding. And it's funny because it used to be like we actually would help out like with a PPM. Like almost nobody writes a PPM anymore, or help out with the deck. But there's a lot of good resources now that are out there to help GPs. So like I said, the new firms we see are a little more polished on that front. The challenge is standing out amongst all the other funds that are out there. So how do you tell your story in an elevated way that's going to resonate with the market? And that's something we've been trying to help our GPs with more recently. And we actually did a press dinner like about a year or so ago, and kind of brought together these top tier reporters from people who cover our industry. We did this in New York. There's some TV personalities as well, and then a handful of our GPs. And the whole purpose of this dinner was to get these reporters to understand that there's more to the emerging manager story. There's different, it tends to be the same narrative, the same stories that are being told. We wanted to open their eyes to the idea that there's a lot more here that's being missed. And then also for our GPs help forward some of those connections. So when it was time for them to go out and tell their stories, they had those relationships. And I think our GPs have really appreciated that. We also work with a communications firm that we pay for like by ourselves because we think it's really helpful to our work. So that's been really big. And then the third way I think that's really important that we help our GPs is through a lot of work that our finance and accounting team does and our CFO, like helping them with figuring out their financial infrastructure, data room, DDQ, reporting templates, who should you hire as an outsource administrator. We've helped interview like part-time CFOs, like that kind of stuff is really valuable too, especially if you want to build a long-term enduring platform. You need that really strong infrastructure. And obviously we see what, the best practice looks like in that area. So there's a lot of ways in which LPs can help, their GPs. If you want to be able to be successful in the long run, I think you need to be active and find ways in which you can help.
Some advice I've heard you say that you all provide to your GPs and just in general is an LP/GP investment memo. Like provide that to potential LPs and say, this is why you might want to invest. Do you still feel that way? Of whether or not GPs should do that?
I think GPs, they need to think about what the LP needs to produce to get comfortable with the opportunity. More often than not, the end product there is a memo. So yeah, I think think through what goes into a memo, just like you would a deal memo. They've got to do a deal memo. What are the things they're going to want to know, right? And work backwards. Have that material in your data room. If you do a PPM, that's a great way to address it. Pitch book, but make their job easier because one thing that's always missing is like a narrative around the genesis of the firm, right? Like everyone wants to know what's the history, and a lot of times, if that's not clearly laid out, it can get lost. And so, yeah, like helping make an LP's job easier is probably going to make your job easier too. So why not?
And I've heard another thing that GPs can do to make LPs' jobs easier is be upfront with your results or
Oh,
numbers or
totally. Yeah,
investments. Don't hide that.
totally.
Just tell them this is what I've done.
Yeah, because good LPs will figure that out anyways. So you're much better off owning your mistakes. And in fact, I think this is something we like is if you don't have a, bulletproof track record that's like, top notch, I think it's okay. It's totally fine. We've underwritten firms with negative track records before. The key is that have you learned from those mistakes? Have you shown that, you have this culture of continuous learning? I think that's more important than somebody who has only been successful. Because I think over time you will run into challenges. You are going to make mistakes, but the key is to be able to continue to learn from them. And if you're transparent about what those are up front, gives us a lot more confidence in the relationship.
You talked about fundraising that you all help GPs with, but you all also do fundraising.
Yes.
And you have described that fundraising can be very challenging for you all too. And we talk to founders, we help them with fundraising.
Yep.
We do our own fundraising. And the statistic is like we probably do less than 1% of the deals we see. You all do
Same.
less than 1% of the deals you see. And so the people you're pitching probably do less than 1% of the deals that they do.
Yeah.
So I'm almost starting to feel like there's a analogy of like, because we've, as someone who's raised money for startups, it was challenging, but raising a fund was even more challenging. I'm now going to assume raising a fund of funds is even more challenging than raising a fund. Is that a good read or not?
I think so. I think it's harder because there's a limited universe of LPs that will use a fund of funds. I think fund of funds face a lot of biases, right? I feel like every day at Fairview, we have to justify our existence. We have to earn the right to exist every day. Performance isn't good enough. Like we've been around 30 years. Obviously, you can't be around 30 years if you don't have
The returns.
the returns, right? Nobody just gets to exist for 30 years. You have to perform. But that's just necessary. It's not sufficient. You always, as a fund of funds, we've always had to innovate, try to think about new ways in which we can serve LPs, new structures, new models. And then diversification matters a lot too, because in this industry, venture goes in and out of favor all the time. Emerging managers, as we've seen, people go in and out of the market all the time. And so we've been good at building a diversified business, co-investment, looking at secondaries. And so that's helped. And also just the model, like we do separately managed accounts and we also do, sometimes it's easier to raise a commingled fund. Sometimes it's easier to raise a separate account, and trying to create a really defensible business has been key to our longevity. But yeah, it's really tough. It's really tough. People out there want your information. They want to take advantage of you. There's very little incentive for a consultant to recommend a fund of funds. And so it's always an uphill battle trying to raise capital.
Let's talk about diversification in terms of not just managers, but also diversity in terms of fund managers,
Right.
so backgrounds.
Okay.
Fairview is recognized for being great at that. How do you all maintain that? How do you all continue to increase diversity in the ecosystem, venture ecosystem?
Yeah, I mean, like I said, the mindset has always been from day one when our founders, Larry and Joanne, started the firm, it was always, if you expand the opportunity set, you will expand your opportunities to outperform. And for that reason, we have an inclusive pipeline. So that's one piece of it. We want to see as much of the market as possible. And the other piece of it is having a culture where you can avoid a lot of the biases, the bias traps that a lot of institutions fall under. So the combination of the two things, I think, has allowed us to be really successful in this category. And the end results are, better performance, certainly. And then also, I think it's made us more resilient as a firm, and we're more adaptable to the market because we're always seeing fresh ideas. We're seeing new firms. We're seeing what the trends are early, and we can, over time, bring those into how we invest. So that's all been a huge advantage. But again, it's very hard to replicate. It's one thing to say you want an inclusive pipeline. It's another thing to actually earn the right to have that. Just on the inbound side, and then obviously not to mention the things you have to do proactively to make sure you're covering the market, whether that's network based, working with trade organizations, being proactive through using data now is a big tool for us. So you do all that work, but then at the end of the day, it comes down to making, taking a fair view, like having unbiased takes on opportunities. I think is really important. The way we do that is, first of all, if you look at our team, we have people from all sorts of backgrounds. That's always been important to us, different perspectives. But that alone also is not important, like good enough. You need to have a culture where people with different backgrounds feel comfortable speaking up and voicing their opinion. So, we've created an environment where opinion, everyone's encouraged and welcome to share their opinion, and it's also respected because that's the only way, people will continue to share their opinions, starting from the, most junior people. And so we have a ton of diversity of thought that comes into looking at opportunities. We try to remove as much bias as possible. And when you do that with a really inclusive pipeline, it's going to lead to great things.
Let's talk about sourcing of diverse managers and sourcing overall. So we invest into military veterans, and in 2021 when we started, it was a lot less inbound than we get now. Now
Yep,
there's just, as you build a brand, and more importantly, as you
totally.
do deals
Yeah.
with military veterans, other military veterans are like, great, we know you do deals, let's talk to
Yep.
you. And so if I had to approximate, we're probably now like 50-50 inbound, outbound. You all have been around for 30 plus years.
Yeah.
So my assumption is it's probably like 80, 90% inbound, 10% outbound.
Our proportion of inbound relative to probably anyone else in the industry is higher, but you know, it is a lot of outbound too. I mean, we talked about how much new firm formation there's been. It's still hard to just, everyone's not just going to come through your door. And so we've put a lot more resources into being more proactive in recent years because things have changed a lot. I mean, it's crazy to think when I first started at Fairview, literally every single emerging firm was knowable. It was, you could really know every single. There's only like 100 or something. Like, it was possible to know every new firm. Things have changed so much. We've really had to adapt our platform so we don't miss things. But yeah, we certainly have a high proportion of inbound.
Let's talk about data that you all have started building to help assess the opportunities you see, and maybe tie that in with the report you all did on the agentic era.
Yeah.
And so, what tools do you all use to ensure that you all stay front and center and you see the best opportunities?
I mean, that takes several different forms. I mean, it's actually hard. There's no good data source on emerging managers because a lot of times these are people, that haven't even incorporated yet, haven't registered. They have a pitch book and maybe not even a pitch book. They're, calling you with an idea or they're talking to you, So a lot of this is analog. And so it's hard to use a lot of tools to capture the true market opportunity. So it is a lot of hands-on work on the front end of covering the market, being in the ecosystem, having the inbound deal flow. Like there's really no replacement for that yet. I don't know if there ever will be, but so that's one piece of it. And then otherwise, we have different tools that we're using to help us track our opportunities, screen them, and then bring them forward. Try to be a little predictive too about who's going to come to market when, if they're already in our database, so we don't miss firms coming back, things like that. But it's more challenging to automate some of these things. But it's, I think it's coming. And then with this, with AI agents on the horizon, I mean, I think the report that you referenced, we were trying to put our heads together and think about, where is this world headed and what does it mean for LPs and GPs and founders? Because even now, like you're seeing how different startups look from just a couple years ago. Like the teams look different, their tech stack is different. They're able to create a product, go to market, and scale much more efficiently. And like it's very evident in the revenue ramps we see in these companies, how quickly they can grow and with relatively less capital. And we're not even in this era of agents yet. So imagine if somebody who has a idea and 1,000+ agents at their fingertips to go build a prototype, like how quickly new ideas will come to market, how much new company creation will be democratized, and how many new ideas will come to market, right? Like it's just going to create, I think it will create a ton of noise, and AI is going to amplify the winners, and there'll be a lot of losers too. Like a lot of these companies will not be venture backable, but there will be so many opportunities. And then I think as a result of that, and this is maybe counter to what a lot of people think around consolidation, I think there'll be more new firms At least that's what our data is indicating already, because there's more opportunities, right? And there's more on top of that, just like there's more young talent that continues to be interested in venture. So if you need less capital to start a fund, it's even lower barriers. You're going to have more funds. And what that does is it creates venture already has a high dispersion of returns, probably among the highest across asset classes. It's just going to amplify that. Like it's right now, it's good enough to be in the top quartile. I think in the future you need to be in the top 5, top 10%, because there's going to be so much noise out there that and so it's going to make manager selection so much more important. It's going to make access to the best people, best firms much more important. That's true for us as LPs. I think it's also true for GPs and founders as well.
I feel just from what you shared that co-investing has probably helped you all better understand the startup ecosystem. Not just being on the LPAC, but like actually getting reports from the startups. Is that true or not?
To some extent. I mean, we invest a little bit later. Usually it's like a mature Series A or Series B. And so at that point, we're beyond the startup phase, quite frankly. But yes, we do, we understand what good companies should look like a little better. We understand, what good products look like, what good go-to-market, what, good teams look like. So I think it has made us better investors. But at the front end, it's just a lot of observing, reading, talking to GPs, talking to founders, and just collecting information directly.
Over the 30 plus years and 50 first time funds, you all have undoubtedly invested in some great firms.
Yeah.
Can you talk through some of those firms and what made them fantastic?
Yeah, there's so many good examples. And I think there's several that fit some of the themes that we're talking about today. One that comes to mind is Altos Ventures, which is a firm that I know you respect and know really well. But I think it's a good story because this is a team, Ho Nam, Han Kim, Anthony Lee, started in the 90s, and they had a sole LP. And after the dot-com crash, that LP no longer had capital to support them. So in 2001, the three of them had to hit the road and raise their first institutional fund. And, it was early 2000s were a tough time to raise a fund in general. But on top of that, you had three Asian guys. One of them, Han, was a veteran West Point grad. And they also had, I think they had negative returns at the time. So talk about like not, the packaging was not, what most LPs would be comfortable with. And for us, we met that team. Larry Morse, our co-founder, led that investment for us. We got to know them in 2001. Took us 2 years to actually get comfortable with that team. And what really, they had good ideas. They had good backgrounds. They were looking at different opportunities. And so there was something there. But what put Larry over the top and there's actually a great web session on this. Stanford GSB did a whole session, and so it's worth if people are interested in like stories of OG like perseverance and venture. It's a really good one. But what Larry saw that really put them over the top were two things, and kind of comes back to some of what we were talking about. One was this idea. I mean, they had failed. I think they had a negative return, and so it was like, did they learn from those mistakes? And yes, like they very clearly had this culture of continuous learning, as he put it. And then the other piece was it was a very hard fundraise for them. It took 4 years. And back then, these were not Zoom calls. Like you were on the road traveling to have meetings with LPs all across the country. And through all that rejection, they didn't turn on each other. They remained committed to each other and to building the firm. And that's super rare, right? That says a lot about their character, their grit, their motivation. And I think that was enough for us to have conviction. So much conviction that so we were their first outside commitment in 2003. They did not have a close until 2005. So we were as an LP out there with the commitment, just hanging for 2 years. I don't think most LPs would stick out like that. And to Larry's credit, he had enough belief to wait it out with those guys, and it was obviously totally worth it. I mean, one of the all-time great funds in that case. But there's several other, even around that time, another good example is a firm called Emergence Capital, which has gone on to become probably one of the most notable enterprise SaaS firms. But they started in the early 2000s too. And these guys, Jason, Brian, Gordon, started this firm focused on enterprise SaaS. They didn't even call it that back then. It was called, the term they used was technology enabled services. And so this concept was, it was hard for LPs to wrap their heads around. Well, I'd like to say that Fairview was super forward thinking, and knew that SaaS was coming, but yeah, I think we had some idea that it was going to be big, but not really. I don't think any LP truly understood the magnitude of that shift and how big that opportunity was going to be. But similar to the Alto story, it was a bet on those three guys, their commitment to each other. They also had to grind out several fundraisers before it was obvious that this was a big opportunity. In fact, their first fund wasn't, the greatest fund in the world. It was Fund 2 and Fund 3 of like all-time great funds in the history of venture. But very similar, thread to the Alto story. And I think if you pull these things forward to today, and there's several other examples across our history, I think we're still, now there's so many more funds and there's more LPs. I think a lot of LPs lack clarity around being able to make decisions based on not having a lot of signal, opportunities don't fit the box, but being able to make a judgment based on the team. I think a little bit of that is lacking. And I mean, there's a good example, this one's not public yet, but it's a team that recently come together. It's a GP from a well-known, large, established firm, teamed up with a founder of two already like iconic AI companies. So really successful operator. So incredible profile, but this GP had backed this founder in his early first company when things were really rocky, and a lot of other GPs were saying no, and the company was on the brink of failure essentially. And so this GP came in and kind of saved the company. And that formed like a really tight bond between these two that I think a lot of other people underestimated. And, their pitch was, it wasn't the clearest. It was evolving through the fundraise. The team wasn't quite in place. But we just felt like it was such a powerful team that was committed to each other that it was worth taking a shot on them. And their early portfolio is incredible. It's one of the top performers already in our portfolio. They have gone out and built, I think, probably one of the greatest network of research-driven AI operators and founders in the world already. And this was not even part of their pitch, but it was like if you knew these people, you knew they were capable of building these kinds of things. And a lot of LPs just missed out on the opportunity because it didn't fit a neat box for them in terms of what you would look for, in a first-time fund pitch. So I could keep going, but there's like tons of examples of firms like that. Yeah.
As you describe those investments, it's starting to feel like what pre-seed investors have to sometimes just take a leap of faith.
You have belief, yeah. You have to have a leap of faith. Yeah.
There's a scene in Inception where the person is asking Leo Tate, "Are you willing to take a leap of faith?" And then on Altos, I mean, Coupang, Roblox,
Yes.
Toss, like
Yeah.
all-time
Hits. Yeah.
all-time hits. In terms of we talked about the past. Now I want to fast forward to the future. So we're in somewhat of a challenging fundraising environment, especially for emerging managers, which probably means it's a somewhat challenging fundraising environment for you all, I would assume. And I'm curious, what do you think is going to happen? Not just 1 to 2 years out, but maybe 4, 6 years out. My take, and this is optimistic, is that like bad times create great opportunities. But I'm curious, that might be overly optimistic.
Yeah, I mean, it's hard to predict how these things will go, but I always look at the past for some indication of how things could play out. And yeah, I think that is one very possible outcome is, I mean, this is what happened in the Great Recession and to some extent through the dot-com crash as well, although that was a bit different and took a little bit longer for the market to come back. But even the Great Recession, I mean, it was nobody wanted to do emerging managers, nobody wanted to do venture.
That's when you joined Fairview.
And that's when I joined Fairview. So it was a tough time. And we had luckily raised capital like right before. And so we were able to deploy in those vintage years, like, 08, 09, 10, 11, like really fantastic. Some like all-time.
That's probably when Emergence happened.
That's when they really took off.
Yes.
Yeah. And some other, I mean, some other awesome firms in that time period. So I do think that things will come around. LPs tend to come back when they realize that they're missing an opportunity, and I think we're starting to see more liquidity in our portfolio. We've had a really incredible year actually for liquidity already this year, so that's starting to open. IPO markets are opening. I think the value creation around that's driven by AI is going to be too large to ignore for much longer, that LPs will come back. But they're going to be more cautious. The ones that are coming back, I think, are taking it slow. They're afraid to take risk. And it's probably a good thing. Like I don't think we need another 2021, quite frankly. So hopefully people come back over time slowly in a more cautious way. But I think things will rebound.
I want to ask a few by the numbers
Sure.
questions. So, your emerging managers are obviously first, second, or third funds.
Usually, yeah.
Will you look at fourth, fifth?
We do.
Okay.
We do. We'll do so in a couple ways. One, in some of our emerging manager funds of funds, we have the ability to continue those relationships beyond a fund three. Or our LPs will transition those relationships to direct relationships if they have more of a strategic relationship with us, and they're using that relationship as a pipeline for direct relationships over time. So some of the best firms, in their programs can be direct relationships over time. And then we also have a program for tenured managers. So in 1999, we started investing with more tenured, difficult to access funds, and most of that has been like the who's who brand name firms, high Roman numeral. But that world has changed a lot in recent years. I mean, a lot of those firms have gotten really large, have evolved into things that are different than what made them successful in the past, at a scale where we think it's hard to turn the type of multiple you'd expect from venture capital, 3x plus type returns consistently. And so definitely has been some turnover in that relationship set, but some of those firms also have remained disciplined around size and remain, in our portfolio. But it's created opportunities for firms that used to be emerging managers in our portfolio to now transition to our tenured manager program. So yeah, we definitely take a long-term perspective, even if it's an emerging manager. We want to have that potential to be long-term partners beyond just the fund three.
Understood.
Yeah.
And then in terms of fund size, you had mentioned 50 probably on the smaller end. And then on the higher end, historically it was less than 250. Is that a good read or probably much higher now?
Usually it's less than 500.
Okay.
We've got some programs that are less than 250. So this depends on the LPs that we work with. Like
Yes.
we'll do SMAs where we have discretion, but we'll work with the LP to craft how they want to define emerging. And so there's different, some LPs will be comfortable doing funds over a certain scale directly, or their minimum check sizes allow them to do that, but they can't do funds over less than a certain threshold. So it can be 250, it can be 500, it can be a billion and 2 billion in one case. So it just really varies. But I would say on average 500 or less.
And then typical fund has around 15 fund investments.
That's pretty normal for us. Yeah.
We're going to move into some rapid fire questions.
Sure.
What are some of your favorite treats or snacks?
My favorite treats or snacks. Okay. I love like trail mix nut packs. I don't know that's super exciting. And just fruit. I don't know, kind of boring, but that's where I go.
Nice. Very healthy.
Yeah.
Favorite travel spots?
We have two young kids now, 3 and 6. So we've been doing a lot of Hawaii the last couple of years, at least 2 years in a row. So it's always fun, easy trip, always have fun. So I guess I'll say that. Yeah.
You have family in Connecticut. My understanding, and Fairview is based in Connecticut. Do you still go back to Connecticut a lot?
I do, yeah, yeah. I mean, probably at least once a quarter. Yeah.
Favorite movies?
The thing with having young kids is you don't have time for movies. But some of my older favorites, definitely, like I love like Ocean's 11. That's one of my favorites.
It's meshes with venture and taking risks.
Yeah, yeah.
Favorite books?
Books, I'm like all over the place on books. I have I have gotten into a bunch of like, this is kind of random. It's like theoretical physics books, and just trying to get like an understanding of how the universe works and how the world works. So it's been like a whole series of books I've read in that category.
Any favorite sports teams?
Sports teams, yeah, I love sports. I grew up in the Northeast Connecticut, so uh, Connecticut's interesting because you can either lean New York teams or Boston teams, and depends on what side of the river you grew up on. So I was on the east side, so it's more Boston. So I grew up like Red Sox, Patriots, and then for basketball, UConn is so big in Connecticut. So that's like my go-to.
Nice. But you were probably a big Kemba Walker fan.
Love Kemba. Love Kemba.
A great basketball player.
Yes.
I want to thank Aakar and Fairview for taking the time to chat. Most importantly, for being a powerful, enduring, important firm that has been advancing VC for over 30 years. May your next 30 years be even better than your last 30 years.
Thanks a lot, Tim.
Thank you,
Appreciate it.
Aakar.
Yeah.